everybody? How is everyone doing? Low on energy? Okay. Can we quickly have a quick intro, like how many of you are, say, startup founders over here? Any startup founders? One? What about others? Are you attending the conference as a, what do I say, students?
They call it students.
Okay. Which year?
Second year.
Second year. Okay. And do you want to start up in some time in future?
Yes.
Awesome. What about you guys behind? What are you guys into? Developer? Okay. And you guys? Developers. Perfect. So I'm assuming all of you guys want to start up at some point of time in your life, right?
Yes.
So I'll tell you whenever you want to start up, how to raise funds, right? That's what we'll talk about. Yeah, I'll quickly give you a brief about myself, right? So I started TDV Partners, which invest in early stage startups at idea stage, which is seed and pre-seed, right? So seed or pre-seed is typically basically when a company just has an idea, you have a team and you want to go out and raise funds, right? That is the stage where I invest. So it's more like betting on the jockey rather than the horse, right? So I bet on the founders and take that call, right? So currently I invest across Web3 as well as Web2. In Web3 I invest in 5-6 startups. In Web2 I invest in around 15-20 startups, right? And these are across sectors like SaaS, fintech, gaming, creative economy, in case if you're aware of, in Web2 as well as Web3, right? And gaming. So that's there. Previously I worked with a VC fund called Innovent Capital. Over there I manage multiple companies which became unicorns. How many of you have used Swiggy in your lives? Any Swiggy users? Amazing. So that was one of the company which I was managing at Innovent Capital. I saw the company grow from a stage where it was very small to becoming a multi-billion-dollar company, right? Similarly, there is a company called Eruditus, which is a tech company where you can go for your higher degree courses. So I invested in them at Series A, saw them becoming a unicorn. So are you guys aware of what the term unicorn means? Huh? Be loud here. Huh?
1 billion.
1 billion, correct. Exactly. So 3 or 4 of my portfolio companies, they became unicorns, right? Since the time I saw invested in them and saw them grow very closely, right? So yeah, that's there. And then obviously Licious is another startup which maybe some of you might have heard. They are into selling of non-veg food, right? And on the logistics side, there is Blackbuck. So that is there. And on the social commerce side, there is a company called Dealshare, right? And obviously there are many more, Fresh Menu and others. But yeah. So yeah, today we will be covering 3 major things. First one is preparing your startup for a fundraise. So whenever you want to go out and start your company, how do you prepare yourself to raise a fund, right? That is the first part we will be talking about. Second is basically how will I evaluate a startup, or how will any other investor evaluate your startup, right? If you know that, then only you can prepare accordingly. So knowing that is very critical for you guys, right? And then third, we'll talk about how do you approach investors, because even after knowing what to pitch, how to reach out to that person or how to reach out to that investor is a very critical element, right? So we'll talk about that, and then obviously I'll give you some of the insider secrets and tips about how to do a successful fundraise, right? So starting with part 1, how to prepare your startup for fundraising, right? So first of all, you need to, it's more like giving an interview, right? I'm sure a lot of you would be sitting for placement jobs in future, or a lot of you would have already done that, right? First thing which you do over there is obviously you know yourself. What are your strengths, what are your weaknesses, you do a SWOT analysis, you do multiple analysis, and know in depth about yourself. So same thing applies for a startup, right? You need to understand what you are building, why you are building, what is the vision, what is your mission, and what is the core customer problem which you are solving for, right? You need to know that. And accordingly, once you know that, then obviously you will be able to pitch in a better way. Then early stage, the important part is building the right team, right? And you need to see whether the team is complementary or not, right? So say for some example, one person is a tech guy, the other person, if he or she is a business person, then that is a good complementary team, right? So that is something which you need to see. And obviously, like, you need to have domain expertise, technical expertise in whatever you are building. Then obviously you need to have a clear value proposition. That what is the problem which is out there in the market and how you are trying to solve it, right? And why you are different from others. So you need to have a clear value proposition around it. And around all these things, you need to create a story, right? Okay. Why your startup is the one which the investor should fund, right? Why not somebody else, but why you? So that is the answer which you will do. And then obviously, like, building for the customer, not just for tech circle. So this is something which happens a lot. A lot of times founders build for their own community because they think this is my problem or this is my developer community's problem, and that's it. You don't, like many founders don't look beyond their own circle, right? You need to go out in the market, talk to the real customers, talk to the larger masses, and then understand the real pain point and validate, okay, is it just my problem or is it a problem for the masses, right? Or your larger audience. So that is something which is very critical, which I have seen in my experience a lot of founders miss out on. If they feel this is the problem, then they go out to solve. They build a product, and then they realize, okay, I'm the only customer, nobody else uses it or needs it, right? So you should avoid that trap. That is very critical. Then second is obviously crafting a captivating pitch, right? See, the best pitches which I have heard are the ones which have been more of a storytelling kind of stuff, right? Where people share their experiences, share why they started, right? So most of the times, I'll give you my example itself, right? So I was a founder in my previous avatar. Back in 10 years back, I started a company called Athleto, which was a sports tech platform, right? The pain point which I was trying to solve was most of the people, they play till their college life. As soon as they move out of college, they stop playing. The reason being, they don't know where to go, whom to play with, and will the place be available or not, right? So those were the key pain points which I was trying to solve and raise, right? So that is how you need to find out the core problem and create a value proposition around it and build a better story around it, right? Then you need to showcase pain point through some validation. So you need to back your pain points or problem which you're solving through some data points as well, right? How valid is it? Is it a bigger thing? So for that you need to do secondary research, which is where you will get all on internet. You will get all the information. And then obviously you need to do primary research, which is basically talking to your customers, talking to other stakeholders in the ecosystem who will be interacting with your startup, right? Then obviously you need to highlight the impact which your startup can create, how big it can become. You need to talk about that, and these are the different ingredients which comes into your pitching, right? How you do the storytelling, how you pitch your company to the investor. These are some of the ingredients of the same, right? And then what all should go into a pitch deck? I think this is one of the most important things. So maybe you can have a look. So basically, obviously, if you are building in Web3, then you need to give an overview of your solution, right? Then you need to explain the nitty-gritties about it. What is the blockchain does, what is the integration, what are the benefits. Tokenomics is a very critical, important thing in Web3, and especially if you are doing a token-based fundraise. If you are doing an equity-based fundraise, then it's fine. But if you are doing a token-based fundraise, then the tokenomics is the most critical thing, because it will define how the tokens are distributed among all the stakeholders at what stage of point of time in the startup's life, right? Then comes the market potential. How big is the market, right? Is it a $100 million market? Is it a $1 billion market? Or is it a $100 billion market, right? Bigger the market, better the chances of you raising money from a VC. Because VCs look out for markets which are $1 billion plus only. They don't look at anything smaller than $1 billion, right? And the reason for that is their own economics, right? That doesn't mean that startup is good or bad. It's just that for a VC model, a startup which is working or solving a problem which is a smaller problem doesn't make sense for them. There could be another set of investors for them, right? So that's it. Then obviously you need to look at the competitive landscape. How is the landscape around what you are building? How many competitors are there? How are you different from them? Right? You need to look at that. Then you obviously need to look at the team's experience, expertise, and check accordingly like what should be your funding ask. Usually, typically any startup when they do their fundraise, they accommodate for 12 to 15 months of runway. In a normal time, in the current markets, which are bear markets, people typically estimate for 18 to 24 months of runway when they are raising. So whenever you are going out to raise, you need to see for the next 2 years what is the amount of money which I'll require to reach and achieve say milestone A, right? And accordingly raise. If anybody has any questions at any point of time, feel free to stop me and I'll answer them. We'll keep it interactive. So any questions till now? Everything is fine? Cool. Then coming to the part 2, which is like how investors evaluate startup. Right? I think this is something which most of you will be keen on. So basically these are the major things. 6 major things which people look out for. Most of them is like team, which I mentioned. The first and foremost is the team. How good is the team? How complementary skill sets do you have? Right? What do you bring on the table? What is your history as a team? Right? Have you been like found each other just 2-3 months back and you're starting to build? Or is it like you have been friends from ages and you know each other well and hence also you have complementary skill sets and hence you're building, right? Most of the times teams which come together for a very shorter period of time where people don't know each other organically, what I've seen historically, they fall off, right? And that is one of the biggest reasons for any startup failure, teams not surviving together. So forming a startup team is as good as like getting into a marriage or getting into a relationship, right? So you need to look at it from that lens. It is at least a 10-year commitment if you want to build a successful company, right? If you have heard of Zomato, they became profitable right now in this last quarter, right? And that was after a 15-year-old journey. So that is the kind of time commitment which you need to have, right? Without that, it's very difficult. So you need to evaluate your team from that perspective. You need to talk to your founder, sit with them, understand in detail okay, what is their vision, what is your vision, is it aligned and is it aligned with the company's vision. That things are required and that are the most important things, right? Second is the market size, which I already mentioned about briefly, like it has to be a big market and you need to do the market sizing in a right way, right? Third is sector landscape, which is like what are the different issues in that particular sector. So say for example Web3 gaming, right? There are multiple subsectors over there. It is like play to earn, play to win. There is just play casual gaming, right? Multiple other different things are there. So you need to see where do you fit in, where there is space, how many competitors are there, and is there even place for one more company in the space which you are building, right? So that is basically sector landscape which you need to build. You need to see what all the things are happening in the world. You need to see what is happening in US, what is happening in China, what is happening in Europe, and you need to see the trends in India, right? And accordingly, you need to triangulate with is it making sense or not. Sometimes, obviously, a lot of things will make sense just for India. Sometimes there are trends, or typically there are trends which have previously worked in US, China, and then it comes to India, right? So, from my experience in a lot of sectors, I have seen India lags behind US by 3-4 years, behind China by 1-2 years, right? So those are the kind of trends we have seen typically. Obviously, times are shrinking. Say if you ask me 5 years back, it was like the timeline between what happened in US and what happened in US like 7-8 years. Now it is reduced by half. And with AI, ML, Web3 all coming into picture, this timeline is shrinking and everything is happening real time across the world, not just in one particular geography, right? Fourth is you need to see what is your right to win. Why will your company win? Why will your startup win? Even if you are competing against the competitors, right? What is your moat? That is something which you need to answer and you need to tell. So most of the investors will grill you on this. There are 3 exchanges, you are making the 4th exchange. Why will you win? How big will you become? What is special about you that will make it win, right? So you need to prepare thoroughly for that and answer that in a way which is convincing to the investors, right? 5th is obviously execution capability. That obviously you do a lot of talking, but have you executed anything in real? Have you built any product? Have you built any traction? What have you done in the past? That also matters, right? So your past history matters, not always, but in many other cases, because that is what will tell your execution capability. Whether are you able to execute, or whether what you are saying, can you actually do it? Because saying is easy, doing is hard, right? So that's all. And sixth is timing. This is one of the most important things. Despite having gotten all 1 to 5 right, if your timing is not right, then despite having the best team, best product, best technology, everything amazing, you might end up failing, right? So you need to see timing, that are people ready for it. So again, I'll take an example over there. So say pre-pandemic, bunch of edtech startups, they were not flying off at all. But during pandemic, they went up like crazy, right? Similarly, pre-Geo era, which is pre-2016, most of the gaming and content companies were struggling in India. But after that, it took off like crazy. Now everybody is hooked to tons of content companies, tons of gaming companies, and both these sectors have mushroomed a lot, right? So that timing, the inflection point was there, which was Geo in that situation because of the democratization of internet for everybody, right? So that is something which you need to see in whatever sector you are building, right? So say in 2021, Web3, crypto, anything, if you do whatever, chances are very high that if you are building something credible, then you would have easily raised. But that's not the case right now, right? So you need to also look at from that perspective. That is it just a hot sector, because in the VC world or in the investing world, every point of time there are some sectors which are hot and they get a lot of investments. And then obviously there are fundamental sectors which will always keep on getting investment, but there is always a flavor of the season. So you need to look at all the trends and see what is working, what is not working. Right? Diving deeper into the team, like you need to see how many founders should the team have. There is no right or wrong answer. I have invested in companies which have 1 founder, I have invested in companies which have 4 founders. But what data says globally is a 2 or 3 member team is an ideal team, right? That is when you can manage your team very effectively and efficiently, and the chances of fall off are lesser. If you have more members, say 4 or 5 or even more, then the chances of failure are higher, because you will have more divergent views, you will have more different views, right? And hence you might end up like there could be conflicts which are possible, right? Then is the founder background, which I already talked about, right? What kind of founders you are working with, what are they doing, and what are you doing? Do you bring complementary skill sets or not? So that is there. Track record is also something which I talked about, skill set I talked about. And the most important is founder startup fit, right? So say for example, you have a background in semiconductors and you are starting up in semiconductor space, then that is a good founder startup fit. But if you have a background in say chemical engineering or say in aerospace engineering and you are starting a food tech startup, that might not make sense, right? Not always true, but many times if you are building a deep tech product, then it is true, right? So that is something which you need to look at, that is there a founder startup fit? For people who have experience, is their past experience helping in building them the next product, right? Because that is where you will have unfair advantage, because you know insider information which other people might not know, right? And hence a lot of such founders are successful, and you can say there is a good startup founder fit over there, right? Then comes the market size. How big is the market? Is it $1 billion plus or not? That is very important. Then there are 3 terms which most of the VCs look out for and they are interested in, which is TAM, SAM. So TAM stands for total addressable market. SAM stands for sizable addressable market, and SOM is serviceable obtainable market. So TAM is basically how big is the market. So say for example, India has 120 crore or 140 crore people, right? So that is, say for example, your TAM, right? Out of that, how many people pay taxes if you are building something in fintech? Let's talk about that, right? So there are just say 6 or 7 crore people who pay taxes, right? So that is your SAM. And out of that, how many paid, 6-7 crore are the people who have filed ITR returns. That might not mean they are actually paying taxes, they are just filing the return. SOM is basically how many are actually paying taxes more than 1 lakh rupees a year. that is your SOM. So which is the serviceable optimal market. So that is the market which you will be targeting actually, rather than going after the TAM, which doesn't make sense, because that is like 140 crore is the people which are there in India, but that is not your market. Your market is maybe say 2-3 crore people who are actually paying tax more than 1 lakh rupees every year, right? So you need to do that correct market sizing. Obviously, most of the times you might not get the right data around it, but you need to extrapolate it through different techniques which are there. Then comes how crowded is the market, right? And is it like a winner takes all market, or is it like a market which can have multiple people, right? So, for example, any exchange, it's not a winner takes all market. It is like there will be multiple exchanges which will stay, and all of them can work efficiently and profitably, right? But say in case of ride hailing, right? So there is a duopoly in India right now. It's only Uber and Ola which are working. Any new entrant, if they want to come, it's very difficult, right? And the kind of investment which will go will be crazy, and hence it is very difficult, and hence it is like one of the winner takes all market. Another example of the same is Swiggy and Zomato, right? These are the examples I think assuming most of you would know these companies, these startups, right? Third is the sector landscape. Okay, how unique is your startup? What differentiator are you bringing which is not there currently, right? So that is there. How many players are there in it? What stages are they? How much funding they have raised? From whom have they raised, right? So those are the kind of questions which you need to do research on, find out answers to, and build for it, right? Then you need to look out for that if say there are already 4 startups in that particular space, is there a space for 1 more startup or 2 more startups, right? So for again taking example of exchanges, there is always scope for more players if there is a differentiator which is there. But if say there is no differentiator, you are doing just the same thing, then obviously you might not survive. So you need to look at those aspects and accordingly answer it, right? Coming to right to win, like why will you win? Why will your startup win? This is one question which most of the investors will ask. So what is unique about your startup? What is unique about you? Why will you win? And how to answer that is very important, right? So what is the delta improvement or marginal? So say for example, if you are building something, is it just like 2x improved than what was already existing in the market? Or is it like 10x improvement over what was there in the market? If there is a 10x improvement, then the chances of customers moving from existing solutions to your solution is pretty high. But if it is just a 2x improvement, then they might move it temporarily, but then eventually they might go back to the previous ones, right? So you need to answer that very well. What uniqueness are you providing? Any unfair advantage which you have, right? So for example, say if you are being a part of any exchange, right? So you know all the information what is happening. If you are building a market maker or marketplace based on that, right? Then that will be your unfair advantage because you have gotten some unique insight, and basis that unique insight you are building something, right? And those are the insights which only you have or very few people in the world have, right? And hence your chances of growing or building and being successful in that particular space is pretty high, right? So that is like a very important thing. And why can this company win is something which you need to answer, which everybody will ask. Most of the times the answer to that is because of the founders. Because at early stage, it's only the founders which are there. Rest all is idea. Ideas can keep on changing. Most of the times, again, when startup starts with idea A, by the time they have grown, it is idea D or E, right? The startup keeps on iterating very quickly, and that's the nature of a startup, right? If something is not working, you change and you do something else and start iterating, right? So hence the most important part is the team. So you need to sell yourself to the investor. Like, I am the person, I am the right person to build this startup. I'll make it go and you need to bet on me. And investors also bet on the founders rather than the startup ideas, right? Most of the time, not always. Then comes the execution capability, where again I talked about like they will go into your past, they will see what did you achieve in the past, like do you have amazing credentials, what kind of pedigree you come from, what have you done in your previous work experience, what kind of activities have you done in your college, like have you been part of multiple organization events, what kind of events did you do at what scale, what kind of funding did you raise for your events and all that stuff, right? Because that speaks a lot about what is your execution capability, right? Then comes like, can they achieve what they say? This is where I was saying the say-do ratio, right? So say I am saying I'll invest in 20 startups this year, but if I end up investing only in 10 startups, then obviously people in the market will know that this guy is saying too much, but he's not doing that much, right? Similarly goes for the founder and anybody in life, right? It's like what people actually say and what they actually do. You need to triangulate between that and see, is it how true or false it is, or what is that ratio, right? Which I call the say-do ratio, right? Then comes the timing. Is the market ready? Are customers ready? What trends support this? So like Geo is one trend, UPI is one trend, COVID was trend, different trends keep on coming at different points of time. So what you know, maybe if you plan to start up in the next 2-3 years, you need to look out what could be the potential trends which would come out, right? So one potential trend which I was talking with one of my friends yesterday itself, could be say if Apple's glasses they work out, then the whole VR industry could be in getting a boom, right? The whole metaverse industry could become huge, which has become dead currently, which was high 2 years back. It can be back in the green, right? And all the associated products with respect to metaverse, AR, VR could become huge. The whole hardware system itself could change from the form factor of reusing mobiles. It would completely move to the glasses, right? Who knows? That is a potential possibility. You never know. Then obviously these are like, are there any tailwinds? Is government regulation supporting? So again, coming to blockchain, crypto, there are headwinds, and obviously government is talking about it right now. There will be a regulation around virtual digital assets pretty soon, and we'll get to know whether it is allowed, not allowed, what is not allowed, all of that things. But those are the kind of tailwinds or headwinds which could be there, which you need to look out for. And then why now is the answer which you need to, question which you need to answer, right? And I think you need not always be the first. Google was the 12th search engine, Facebook was the 10th social media network, iPad was the 12th tablet, and there is no requirement that you need to be the first one out there to win. You can be the 10th, 12th, 15th, 20th, whatever, but you need to be 10x differentiated than your competitors. You need to have an amazing product than your competitors. That is something which will matter, not anything else, right? So yeah, this is the master summary of what all investors look out for, right? If you maybe spend a couple of minutes on this, you will get a good idea. So one is obviously like problem statement. What problem are you solving? How big is the market? That becomes the second. So you do all the market sizing, tailwind, what all we talked about. Third is the team. Fourth is product, tech. Fifth is the competitive landscape. Sixth is the economics, which we didn't talk about. So how will the economics of your startup make sense? The unit economics of your startup, how much money are you making or burning, right? What is the margin structure? Is it like gross margin positive, CM1, CM2? Are you guys aware of any of these terms? If not, you can stop me and you can ask. Right? Whatever you don't understand, feel free to stop me and ask. Not an issue at all. Right? So those are the kind of things. Then obviously pricing. How do you price your product? It's a very critical element, right? Because something could work at price A, but it might not work at price B, right? So you need to come up with the right pricing strategy, which is a very important thing. And then obviously you need to have a financial model around it. Then comes the defensibility. Okay, for example, is data your defense? Do you have so much data that nobody else can replicate? So for example, LLMs, AI is the in thing right now, right? And over there, data is the mode, right? Whoever is sitting on tons of data, they can create amazing LLM models, they can create amazing AI startups because of the kind of data which is there, because of the kind of machine learning which could be done on top of it, right? Similarly, you need to look at the network effects, right? So, great example of network effects is Uber, right? Where one driver led to customers and customers led to more drivers, and then everybody got connected, right? And it happened not just locally but globally, right? So, what kind of network effects can your startup have or not have, right? It can also become your moat. What are the barriers to entry in your startup? So say if you have gotten some contract, if you're working with government, if you need to get a contract, you need to file a tender, right? And once you get a tender, then you are in and everybody's out. So that is a entry barrier which you have created, or that is something which is created in your website or in your particular startup or area, right? So what are the different kind of entry barriers which you can create for somebody else to come in? So say for example, if somebody has to build an exchange, you need to get an exchange license. So in order to get an exchange license itself, you need to invest $10 million, right? So if some startup has raised $100 million and they have got an exchange, if I want to start up, I need $10 million at least to pay the exchange guys to build a startup. So that becomes an entry barrier for me. Like I cannot get into that particular space because there are 10 people and raising $10 million on day one for me is very difficult, right? So those are the kind of entry barriers which could be created. These are some examples. And then obviously what are the switching costs, right? So for example, say if you are building a data AWS for Web3 or say ICP of Web3, right? And paying currently, I don't know, say 1,000 rupees per 1 GB of data, right? To store, or 10 GB of data, you are paying $1,000 a month, right? And because your data is already there and you are doing analytics, you have integrated tens of tools over there. If some new competitor comes and I come with company B and offer say at $500 also, people might not move because I need to move not just my company's data, but all the different analytics which I am doing on top of it, all the different apps which I have integrated on it. So that is crazy work, right? So people might not move still. So what are the switching costs? When it will make sense, when it will not make sense, is something you look out for, right? Then comes the scalability. Okay, will this opportunity idea grow exponentially or will it be a linear growth, right? So again over here, examples mostly in any D2C or consumer brand, the chances of that company growing are linearly rather than exponentially, right? Whereas for any digital or tech company, the chances of growing them exponentially is very high because there is no physical element which is required, right? You can grow digitally sitting anywhere in the world, doing Facebook, Google marketing, and you can grow, right? If you have a good product, obviously. Then what is the GTM? GTM is basically go-to-market, right? How will you distribute? Whom will you distribute through? What are the different channels through which you can distribute? All that you need to look at for. And then comes what is the adaptation potential for that particular product or service which you are offering. And then what are the exit options, right? So that also you need to look at. So that's the last thing. So as an investor, what investor is interested, he or she is interested in, if I am investing 1 million, will it become 100 million or not? Will it become 10 million or not? So they should be able to see the path to exit. Can you showcase them that path? That is the one single most critical element for an investor, right? So they might not ask about it, but they will do that calculation and everything on the back of their mind. If you are able to tell them, if I grow this much, then your potential exit could be X amount. You don't need to specifically mention it, you just need to draw them towards that direction, and that is fine, right? But as a founder, what I've seen is most of the founders don't do this. They don't think of VC as their customer, or rather they think VC also as their customer rather than an investor who is looking out just for exits and making money, obviously creating the value over the period of time, and that is how it will happen. But the ultimate goal for any investor is making money. So you as a founder should also know how will you make money so that your investor makes money, and that is why he will invest in you, right? Any questions till now? Anything? Anybody has any queries? Yeah.
So, like, how can we validate an idea without creating proof of concept?
So you can do that through surveys. Say for example, you want to build whatever, you can just float a survey around it that, is this a problem for you? If yes, what is the solution which you are using right now? If no, then why you are not using it, right? Is it non-existent? And if it is say non-existent, if you build something, will they be open to using it, right? And if yes, then at what price point, right? So those are for different problems you need to design different surveys and do a survey in a group of people, right? Where you can get say at least 200, 300 replies, genuine replies, right? Then that will give you some idea. The more the number of replies, the better validation you will get whether there is actually need of the product which you are building or not in the market, right? So this you can do without building the product itself. It's just an ideation thing which you are doing in past, and you can do it over Twitter, Facebook, LinkedIn, whatever, right? These days polling has become very easy and taking surveys has also become very easy, so you can easily do it. If you are not doing it, then that's a problem. You should definitely do it, and that should be one of the starting areas, right? That's how all the founders who have raised money or who have built big companies, that's how they start, right?
I have one more question. Like,
Yeah.
We group early adopters over here. So how can we find actual early adopters so that we can get a better constructive feedback so that we can build the product into a better feasibility and scalable app?
That's a very good question. I think the answer to that is building a community around it, right? Once you have a very close-knit community which is passionate about what you are building, which is passionate about what is the thing that you are building and what problem you are solving, then they will be your cheerleaders, they will be the ones who will be helping you out, right? And you can do all your experiments over there, right? And I think that is something which Web3 has done fantastically. And first thing which they do is like everybody builds a community. You build with the community, you involve them, you showcase your journey, and hence that is how you can build a better product also. What is important though in this community is that it should be a diverse community. It shouldn't be a very singular community, right? Where everybody is talking the same thing. You need to have diverse opinions, you need to have contradictory opinions, because that will enrich the experience of what you are building, right? So that is important. Anybody else? Any questions? No? Okay. So we'll move on. Third part is how do you approach investors, right? You have done your basic homework, you have built your pitch deck, you have built your story, you know what investors want, so you have prepared that. But how do you reach out to them? That is the most critical part, right? So before that, we'll talk about like most of the companies do KYC. You need to do KYI, which is know your investor, right? What are the different kind of investors? So these are some of the different kind of investors. First is obviously the angel investor, who will put in the first check. It could range from anywhere $1K to $100K, $500K, right? So this is if you are starting out, this is the most important investor, which is the angel investor, right? Who will put in the first check. Then comes the community-based investing platforms. There are tons of them out there. AngelList is there, Let's Venture is there, many others are there globally as well, right? And these platforms help you raise anywhere from $1,000 to $500K, right? So that is the second set of investor. Third comes is as you grow, maybe you want to raise, say, a bigger round, right? So in fundraising also there are multiple rounds or series which you do. So typically at idea stage, it is the seed check or pre-seed check which an investor will invest in you. Then once you have built the product, once there is some PMF, then a series A investor will come and they will put in the money. After that, series B, C, D, and so on, right? So typically at idea stage, at seed, pre-seed stage, angel investors, community investing platforms, and micro VC. These are the three type of investors who will come and they will help you out, right? And they will invest in your idea. Once you are done with that, then comes the institutional venture capital firms who can invest anywhere from $1 million to $100 million, right? So this is like series A, B, C, D, whatever, right? Then comes the PE funds, which can invest between $50 million to $500 million, right? So these are the big guys which come in at series E, F, G, whatever. And then comes the crossover funds and pension funds and sovereign funds, right? So these are the variety of investors. So you need to ensure and do your homework that which investor you are approaching, right? You cannot approach to all the investors because there are thousands of them. You will end up wasting your time as well as their time. So approaching the right investor and hence doing your KYI is very important, right? Then is the investor due diligence. So once you identify the investor, you need to do one step further work, which is like what is their investment thesis. For example, are they investing in the sector in which you are building? Are they investing in Web 2 or Web 3? In Web3 also, are they investing in infra projects, or are they investing in metaverse? Are they investing in blockchain products, or just Web3 gaming, right? So you need to go out and talk to them, do research, find out and figure out who invests in what and at what stage. What is their investment thesis? Do they come pre-product or do they come after the product is built? Right? These are the kind of questions we need to do, and you need to do more research about each of these investors which fall under your bucket. Right? Then you need to see the fund size. How big is the fund? Is it like $1 million fund or $10 million fund or $100 million or $1 billion fund? Right? And how many bets can they take? What is the average check size of each investor? Right? Will they put in a $100K check, or will they put in a $500K versus a $1 million check? Right? Basis that, you need to calculate how many investments they do. So most of the investors have all this information on the website itself. That, for example, I invest between $50K to $500K. Right? That's my range, or TDV partners. I put out a thesis as well, that I invest in Web2 startups as well as Web3 startups across sectors like SaaS, fintech, gaming, creator economy, social. Right? These are the 5 sectors in which I invest. So that way, every investor has put out, and if you Google, you will still find out what kind of investment do they do, right? Then you need to look at what is their average check size, which I said. Then are they active or inactive? Many funds are, so there is a different phase in funds also. First 2 to 3 years they raise money. After that 2 to 3 years they invest that money, and then again the cycle repeats, right? So you need to find out what stage is the fund in their fundraising journey or fund cycle, right? Are they raising money? So in many times, if they are raising money, they might not have money to invest. So, and in that cases, they might not reply to your queries, in which you will end up wasting your time and being hopeful, right? Which happens with a lot of founders. So you need to know whether the fund where you are going to pitch, do they have money to invest also or not, right? And are they actively investing or not? That is what I mean by active and inactive, right? So there are some active funds, some inactive funds, but that's a cycle which keeps on changing every few years, right? What kind of value add do they do? So over there also, investors are again bucketed into 2 types: active investors and passive investors. So some investors, they help you with multiple things like fundraising of next round, hiring of team, strategy, building the financial model, multiple things. And then there are other set of investors who are like, they just invest money and they are fine. You do whatever you want. I don't want to get involved in the business, right? So you need to look out for what kind of investor is a good and right fit for you. Will they make sense or will they not make sense, and all that stuff, right? So you need to do that. Then you need to see where are they in the life cycle of the fund, which I said, like do they have money or not, and do they have a follow-on strategy, right? So most of the investors, when they invest, they don't look at company just on investing once. They look at investing it over a period of time, right? So for example, if I'm investing $100K in a company in round 1, which is at idea stage, I'll have $100K reserved for them in the next round as well, right? So say if I want to raise first round of $500K and next round of $2 million, right? So if an investor who invests only in one stage, if they have invested, then the next round is completely empty, versus an investor where say they have taken investor who does follow-on investment, then the next round allocation is also half that, right? So for giving again that example, 500K, over there if I have put in 100K, 100K is already done for the Series A round as well. So out of the 2 million, 100K is already done. Similarly, there will be other investors. So through the existing investor itself, out of the 2 million next round which I'll have, 1 million is already filled, right? So that is a strategy which you need to have, and you need to think about it, like how it will work out. Then third thing is the investor outreach strategy. How do you reach out to them? What is the way you reach out to them? Is it a cold calling? Is it at some event? Or is it through some warm referral? Or is it through a founder referral? All of them have different weightages, and they can get you a meeting or they cannot get you a meeting depending on that, right? So you need to have a content strategy. One thing which you can do is obviously build a lot of buzz around what you are building, how you are building, before you actually go out to raise funds, right? Because every investor is very active on all the social media channels. Lot of investors or the analysts or junior people at the VC funds, their full-time job is to just scrape all the possible sources in the world to find out the best founders, right? So if you have built a good content over, say, Medium or LinkedIn or Twitter, then chances are if it catches their interest, they will reach out to you. And that inbound is a great opportunity rather than you reaching out to them, right? So you need to have a content strategy to engage your community, which will indirectly also get investors onboarded, right? Then you need to create a sense of excitement and momentum, right? So you need to keep on doing this regularly. It can't be that you're posted today and after that you're posting after 1 month and then you're posting after 2 months and all. You need to have constant bombarding because in today's world, everybody is like attention deficit, right? There is crazy attention deficit. There's so much overload of data and content that people will just forget. So you need to keep on bombarding them again, not bombard is not the right word, but you need to keep on creating content and showcasing and build a momentum around the fundraise, right? Then ideal way is the inbound, which I mentioned, and then comes like the best is referral. If you can get referred to any investor through their existing portfolio company, that is the sure shot way to get at least a meeting with the founder, right? With a VC. Then is obviously getting referral through some other known people. Then comes obviously reaching out through online channels, be it Twitter, LinkedIn, whatever. So these are the different ways in which you can reach out. And yeah, this is one secret that a lot of people they do. A lot of founders, when they come in the first pitch itself, they think they will get to hear yes or no, and hence they explain each and everything in detail, right? But you need to get into the investor's shoes, right? On a daily basis, I see at least 5 to 10 pitches, right? I spend 2 to 3 minutes on each deck. And what I filter is what I like, right? I filter them and then schedule a meeting. So the importance of first meeting with a founder or a first call with a founder is just to get them interested enough that you get a second meeting, right? So just show them enough that is interesting them to get the meeting, but don't show everything that they get like, okay, ठीक है, शांति से call लेंगे and शांति से कभी होता नहीं है. That's what it happens in reality, right? So striking the right balance over here, what to show and how to get interested is an art which you need to master, which will happen over a period of time, right? So this is one of the secrets. Don't ever make that mistake of pitching everything, telling everything that you are doing. Ask for a more time, like after pitching for 2-3 minutes or whatever amount, tell them when can we have a detailed question or detailed call around it to where I can take you through all my what I've done in my life as well as in startup in detail. Over there you will also get an idea whether the investor is interested or not. If they are interested, then they will schedule a call or they will plan to schedule a call. If they are not, then you spending more time on them doesn't make sense. So you will also know, and you will know where to spend time and where not to spend time, right? So this is one. Second is most of the time people go and ask for money. What they get is advice, but if you go and ask for advice, you might end up getting money, right? So this is a very important thing which most of the people don't do, but this is what happened, which I've seen anecdotally as well as an investor, as a founder also. Right? Like whenever people come and ask for advice, what they do is they make you part of the journey. You feel like you are also owning a part of that, and you feel attached to it, right? And hence you want to give more to it. And over a period of time, obviously, you build a likability, and chances are, if all the other investment parameters check out, then you might invest in them. Versus if somebody is directly coming and asking just for money, then it is more transactional, which might not work out. It doesn't mean it will not work out, but chances are relatively lesser than the first approach, right? So choose wisely whether you want money or you want advice, right? Third is reaching out to the investor, which we already covered. I think through the existing portfolio companies. So for example, I have 24 portfolio companies right now. First preference which I give to any pitch which comes to me is through this founder network, right? Through these 24 companies, I have more than 50 plus founders in my network. So whatever company comes to them, I have a upper priority to prioritize them and give an answer first, right? because I know these are the guys who have gone through the drill. They know what will work, what could work, what will not work. So they won't send any random shit. They will send only companies after filtering at one end. And that is what investors like, because everybody's time is crucial. And that is the most important way in which I will look at that. Right? So whenever you are going out to raise funds, ensure that you go through the right channel to at least get a meeting. Right? Once you get a meeting, then obviously it's up to you. But getting a meeting itself is the most important part, which most of the founders are not able to get with the investor. Right? So that's it. Any questions? If you have, happy to answer. Any questions, any queries? Yeah.
I would like to know more about the negotiating aspect, when the founder, when the VC is interested, and now you have to negotiate regarding the amount.
Terms.
Okay. So I would like to know more about it.
So I think it's more about supply and demand, right? So say if you are raising $1 million, and if there is only one VC which is interested in you to put that check, then obviously you do have a lower negotiating power, because you know if this guy says no or if this girl says no, then you are gone. So what your strategy as a founder should be to get more term sheets, get more interest from other investors, right? Obviously you need to check and look like which investor is the right fit. So there is an investor founder fit also, right, which is an important aspect of this whole startup ecosystem. So you need to get more term sheets from other investors. So say for example you are raising 1 million from one investor, now maybe you need to pitch to other investors, or you would have obviously pitched to many investors, right? What you need to do is convert them. Once you have 3-4 investors vying for that same $1 million, then obviously you are in the driver's seat, because the demand is more than the supply, and hence it's a simple supply-demand equation which works, right? Did I answer your question, or you were looking for anything
More in terms
specific?
of deciding the percentage and.
So yeah, percentage-wise, it's a pure play negotiation and it's an art. But if I have to tell you the range, when you are raising the first round at idea stage without any product or anything, typically you can expect to validate anywhere between 10% to 30%, right, at idea stage. So that is the typical range. Whether you end up at 10% or 30% is your skill, and that is an art, right? There is no right or wrong answer to it. How you negotiate, it will completely depend on that. So yes.
Thank you.
This is not related to directly to the investment, but think about this way. I have been offered a technical co-founder role, and I'm not putting any money. It's a respect equity.
Okay.
And how much I should ask in terms of percentage? Say there are 2 founders who are putting money and everything, but they're business development guys and they don't know anything technical. And I've been offered a co-founding offer. So what should be the percentage generally?
So see, it will depend. Like there are numerous variables associated. But say if these 2 guys who are the founders, if they are they in the operating role or not?
Yeah, they're basically
Or
CEO.
are they sleeping partners or active partners?
Active partners?
Active partners.
Yeah, my role maybe in future maybe a CTO, but
Okay.
as of now it is a technical guy who is building a solution.
Correct. So here, see there is no right or wrong way. One methodology which would make out is what is the worth of effort, energy, time which you are giving, right? How much would it translate to your package if you were say doing the same work somewhere else? Say if that amount is 50 lakhs, 60 lakhs, whatever X amount, how much would that translate to the current company's valuation, right? That is the ideal approach to go about it. Say if the company's valuation is 10 crore and you are say worth 1 crore over there, then you can ask up to 10%, right? Just giving random numbers, right? You need to do the math yourself. But that is one approach. What is your worth? How much are you bringing to the table? Not just now, but in the future also. So you can give a premium basis that, right? That is one approach. Other is you take say 5% right now and then you can have milestone based further follow on equity additions to it. So say for example, if you stick around for 1 year, you deliver product 1 and 2, then you will get additional 1%. After year 2, if you are delivering product 3, then you will get another additional 2%. Right? That is another approach where you take X amount right now and then keep adding on to it basis your performance. Third approach could be obviously a mix of both, where you take some part in cash and then some part in sweat equity, right? But have a watertight agreement around it is what I would suggest. Because a lot of time what happens is it's all verbal, it's not put out on paper, it's not legally binding, and that is not a good thing for you.
Second thing is, for example, I take a 5% or something like, and in future there's going to be investor where the overall my equity will be diluted, right? And you're talking about if you say go for a milestone based 1 or 2% like that, right? So how you calculate? In the sense there are one investor because of my 5% has become 1%, and now.
See, that will be again like depending on that stage, right? If obviously your 5% has become 1%, company's valuation would have also gone from 10 crores to 100 crores or more or less, whatever, right? So, in pure play value terms, your amount of 1% has increased from what it was, right? 1 crore has become say 5 crores or 10 crores. So that also you need to see, right? But you need to ask as per that way, say if it is at that point of time, that 1% maybe would get diluted to 0.5%, so that will happen. You need to obviously decide it upfront, and depending on the round and performance, you can have a complex formula as well, or you can have a simple thing. So that is completely up to you. So there are people who do complex things, right? So say where if you are delivering after year 1, you will get additional 2%. Then you can put an additional clause, if you raise another round, then I should get 50 lakhs plus this percent, right? That is something which you can do. Look, it's not a easy, simple thing. It's a very complex thing.
But
Maybe we can connect and we can
no
talk.
standard.
There is no standard. There is nothing standard in VC world. It's all up to negotiation. Yeah. Anyone else? Yeah.
You said that ask for advice and not for money. So what advice should I be looking for? Like what should I ask them?
It depends what you are building, right? So for example, you are building a SaaS company, right? Then you go and brainstorm with a VC who has been into SaaS space, right? Ask for their experience. So if you are building, say, go to market some marketing tool, right? Then if they have invested in multiple marketing tool companies or SaaS companies, they would have seen the journey. What are the pitfalls? What works? What doesn't work? And accordingly, you can start talking to them and asking for their advice that I'm doing this. Can you help me? Am I on the right path? What are the mistakes which founders or startups do at this stage? And then they will start opening up. They might tell that this is something which you are doing right. This is something which you need to change. This is something which you shouldn't do, right? So that is how you build that capillary and you get advice. And over that journey, you will realize whether they are liking what you are doing or not. As well as they will also understand, is it of keen interest for them also or not, right?
So if I'm working on a project, so should I tell them everything about the project or should I take it in stages?
Yeah, I get it.
I mean, if I'm talking to a VC and asking for advice, so should I tell them everything about my project and every detail or should I take it in stages?
So yeah, it will depend. It's a complex thing. Sometimes you need to tell everything. Sometimes you need to tell partial things.
So overall, is it good to tell everything about your project and everything?
You need to see, does their portfolio have a competing company with you or not? Or are they invested in any of your competitors or not? If they are, and if you are telling them, obviously it's harm to you because you are letting out your secrets to them. If they don't have, then you can be more open and you can completely tell everything, right? So that's fine.
Thank you.
So, thank you.
Any more questions?
Sure.
So this is a bit specific question. We do have a product already, and it's already been in creation over.
You have or you don't have?
Already there.
You already have.
Already there. So we have approached some people who are ready to invest. But as I don't come from a college, I'm a college student right now. I don't come from a very strong college background. I are strong. Due to which they always undermine our abilities, and even the investors give us like a lower percentage of share or whatever. So this problem has been because our bills will be very high because we are using high number of servers, etc. We are not able to expand it due to these reasons, and we have been struggling with it for almost 2 to 3 months now. One of the recommendations was given to us is get a person from a very well-known college into your team, give him as a dummy candidate, do marketing on his name, get money. Should we go with that, or should we still struggle for our system itself?
Although I won't agree with getting him as a dummy candidate. That won't work. For sure. Today or tomorrow, investors will figure out. Right? So that won't work. If you can get them for real, that is the best thing which will happen. Right? If you can get them in your startup as a co-founder or in whatever capacity for real, that is the best thing. So that is part number one. If that is not happening, I would say you can try out for grants, especially when it comes to data platforms, or Google Cloud is there, which is already there over here, AWS is there, Microsoft's thing is there, everything is there, right? So all of them, they have their grant programs, talking to their particular use case, right, which is around credits. So everybody has a credit program. They distribute $10,000 worth of credits annually, 50,000 depending on. So they also have a criteria, and they also, you can pitch to them, they will give credits. A lot of VCs, they have partnerships with all these cloud providers, so they also can get you that thing. So even if you're pitching to VC, you can ask him, if you are not investing, that's fine, we need this, can you provide us with the cloud credits? And many a times, if they are interested, they could help you out with that. Right?
In addition to this, we do have professors from very well-known colleges who are in par with us. So they were recommending some students of theirs. Should we take them as our co-founders, or should we have them as separate entities?
And then have the students as your co-founder, you are saying, of a well-known institute?
Yes.
But will they be working on what you are building, or will they be just a dummy candidate?
No, they will be working because they're recommended by professors.
Okay, another, if they are working and if it is fitting in your team, then why not? You should definitely have them. Right? But as a co-founder or not is your call. You need to see, will they bring the kind of passion, and do they have that kind of belief in what you are doing, or are they coming more from an employer mindset? So there is a founder mindset and there is an employer mindset. You need to look out for that, and you need to test that out, right? Which one is it? So,
Thank you, sir.
Anybody else?
How much equity do we expect to dilute if we are already having a product but we have never gone for a round of funding?
First round?
Yeah, first round.
So I mentioned about it. It's between 10 to 30% is what you can expect to dilute in your first round.
But
right?
Even with a product, already ready product and a good user base.
So if that's the case, the 10 to 30 is a big range,
Yeah.
right? So you might be in that 15 to 20 or maybe above. But range is more down to that, right? And there are tons of factors which affect. I'm just telling you a very broad range which is going on right now in the market. There are cases where people have raised at 5% dilution also, and there are people who have raised at 40% dilution also. But majority happens between 10 to 30%. Right? That's
One last question.
yeah.
One last question. You guys can ask. So, as a seasoned investor yourself, have you experienced any kind of radical shift in the interest of the investors when they are pursuing a Web2 idea versus a Web3 idea? And if they do get excited about a Web3 idea, what are the key things that they look into? If or not, whether they come from a Web3 background or not. What's your recommendation?
So yeah, right now obviously the interest in Web3 is at all-time low is what I would say. But having said that, there is enough interest in the Web3 infra projects, right? Not the metaverses of the world or not gaming or nothing, but infra is something where still investors are investing, they are bullish, because you need to build good infra first. Then only things will happen, right? So there is enough interest in that space. Obviously, it is not easy as it was in say 21 or 22 first half, right? People are asking what is the exact value which you are bringing, what kind of revenues can it generate, what kind of unit economics it will have, right? All the fundamental business questions they are asking even Web3 founders, which was never asked before. Right? So that is a big change. So you need to prepare and you need to answer all that. If obviously the business is making sense, it is having business sense, and you can showcase a way to profitability or growth and revenues with good unit economics, then obviously they will be more than happy to invest. Right? And investments are happening. In fact, at early stage, seed, pre-seed, pre-series A, series A are the only stages where maximum funding is happening right now. Right? Later stage funding has literally stopped. What I would say.
So when the product comes to fruition, they get to realize, they get to see the future picture of whether it's going to bloom or not.
Correct.
Thank you.
Cool. Thank you guys. I hope everybody learned something new and it was of some value. It was a pleasure having you. Thank you.